of you. Welcome you to today's webinar. Today, the topic is options, weekly options, call and put performance and the strategies. Now, let's try to complete it in the next 45 minutes, but if not, we will carry it forward to the next session on Friday. I request your deep attendance to this because we are going to talk about some important characteristics, I would say, and then outline the strategies that you can do and the profits that we have obtained over a period of time. We are also going to highlight the performance over a period of say 7 years, that is from 2014 till date, and also we are going to look at what happened in the last 1 year or so that we have a comparison of a farther period, the probability and the performance. Similarly, we are also going to see the probability and performance in the last 1 year or so. Based on that, you will get some confidence. Now, the reason why we are having this webinar is to outline some strategies where probably you don't need to look towards shuffling every day, or probably looking at charts every day, or being overtly concerned about the nature of the movement, because if you see the market, at least in the last 2 months or so, there are ups and downs movement. When you think it's likely to go down, it goes up. When you think it's going up, it starts coming down. So most of them traders, they get on their wrong foot, one. And second thing is, the confidence is shaken, right? So you tend to stand aside for some time, and during that particular time, the market either roars or falls, where probably your earlier system would have worked well. So in order to overcome certain agonies of trading, it is important that you look at what happened in the past, that is the past history of a call or put performance, what strategy that you should adopt consistently to make money, and also whether those strategies are able to beat even the Nifty movement, or probably give a higher return, that is in the sense higher return on the investment. Maybe the movement may correspond a little lower or higher than Nifty, but whether the money that you are going to put, instead of one Nifty contract, if you put in these strategies, then in that case, what is the return on investment? So we are going to narrow down first to the weekly strategy, and then probably expand it to monthly strategies also. Now, before we go into that, let us look at what happened today. Now, this is the weekly chart. Last week, we said that if there is a fall towards 14,470, 480 levels, you can be a buyer, and it is likely to probably cross this month high or last month high, based on what we have seen of the past month movement. Now, of course, there is a caveat that in case if the corona infection intensifies, where more lockdowns are being put and the economy struggles because of that, then probably what we are saying today, or probably what we said last week, may not hold true. So that is a big risk game, and where probably will be helpless. But at the same time, these strategies will even take care of that or cushion your losses in case if something goes wrong, which should not happen. But in case if something goes wrong also, you are not hit very badly as far as the performance is concerned. So we are going to highlight such type of strategies which will be helpful for you. Now, said that the weekly today, the open was little hopeful. It opened at 14,479, then had a fall up to 14,418, but quickly rallied almost to end flat compared to the Friday close. So if you look at the daily chart, you can see that there is not much of a difference between the close on Friday and today's close. I think it's almost a very flat close. One point that we have highlighted before also, and again we come to that, that's a very special pattern. Again and again we are insisting that this particular close has not been breached. There must be some high which breaches this particular close. So this close was 14,894. Today when it fell to 14,470, 480 levels, then you have got something like more than 400 points, okay,
to be covered, and at some stage within 20 days that 420, 430 points is going to be covered. So we suggested that probably during that particular fall, when a 15,000 option trades around 80, 90 rupees or so, or 100 rupees or so, then probably it's a good time to look towards some sort of a buying at that particular position, or some other strategy where you can do a put spread or something like that. All these things we discussed on Friday. So, but the only main message that we wanted to convey is you will have some more than 400 points of profit. What strategies that you want to put in order to capitalize on that 400 points, I think it is to be left to you. Now, having said that, we will now look at the market movement which happens in a particular week. That is what happens in a particular week. Okay, what are the outer bounds of movement, and to where exactly it closes on a close to close basis on a weekly basis. That is, when we talk about Thursday close, which is the settlement close. So Thursday to Thursday, what happens? So that you are interested in putting weekly strategies. So the weekly strategies, what sort of performance does a call and put have? So generally speaking, we have all been told that the call and put normally have unlimited profit. For a buyer of an option, there is an unlimited profit. In earlier webinars also we said that the buyer of an option is like buying an insurance policy, and the seller of an option is like an insurance company. If the sellers of options are to go bankrupt for some reason, then there won't be any insurance companies also. So that gives a message that the seller of an option need not be at a loss in most of the circumstances. In some circumstances, definitely there can be a loss. Now, the insurance companies also, a lot of insurance companies go for a reinsurance, right? So they hedge their big risk, take small risk, and probably hedge some big risk. Okay. Similarly, here if you do a sell of option, it is better that against an adverse movement, we protect ourselves with a spread option. Like this, now buy a put option or buy a call option against our sell option at some level, which is, in the case of a put, it could be a lower strike. In the case of a call, it could be a higher strike. So these are strategies that we are going to consider. Now, first of all, I wish to tell you the character. This is not a very, at this moment I am not making one recommendation or any suggestion that you should do like this, you should do like that. We are only just going to highlight what probably, the probability of a call option or put option profit, and also the profitability that has happened over a period of time. So for that, we will look at sorry for the technical hitch for a minute or so. audio contact was lost. So the call and put thing is known to you. That is what the buyer of a call option expresses a view on the upside, and a buyer of a put expresses on the downside, right? So the issue is that whether whatever that you are going to talk is about for somebody who wants to do certain things consistently. Consistently in the sense that every week he does the trade. Okay, Thursday and he does a trade for next Thursday, then he closes. Then next Thursday he again opens for the next Thursday. Now we are only talking about one activity on a Thursday, and then you remain even passive. I am not. There can be some activism depending on certain movement. We will come to it later on. But let us say you are passive. That is, on Thursday you put a trade, and next Thursday or the settlement rate it is closed. Okay. If that is going to happen, then in that case, what is the performance? Now, exactly contrary to this is that you buy a call option, you trade it in the way you trade a futures. That is, you buy a call option and then you put in a stop loss, or you take a profit at some stage. So you are trading it like a normal way of futures churning or trading. Now there we have had problems, right, in the sense that you experience both losses and profits, and you are unable to, let us say, get over the emotions of a loss, and so you struggle. Normally anybody struggles to come back, and thus discontinuity really damages the profit profile. So to overcome that, let us assume that somebody wants to do certain things consistently. Now it is very known fact that over a period of time the market goes up. Okay, I am not talking about individual stock right now. Whatever that we talk about index right now also applies to individual stocks. But let us say for a moment we are looking now only at Nifty. Now over a period of time it is known that Nifty will move up. Now 5 years back, it was around, say, 6-7 years back also, Nifty was around 8,500 levels, and right now it has come to 14,500 levels. So there has been a movement of around 6,000 points, and for sure that this movement will be on the upside over a period of 5-6 years. Percentage of movement, whether it's going to be 10% or 15%, that will depend on other factors, but there will be definitely an upside movement that is possible. Now, which will happen. So you know that very well that between the cash market and futures market, the cash market full investment, in the futures it's a leverage thing. So probably you put in 15% or 20%. You have some MTMs and then you carry it forward. So if you get a performance which is more than the rollover cost, because in futures you have the rollover cost, and the rollover cost is nothing but the interest rate differentials, or interest rate minus the dividend. So let us say you get a performance which is better than the rollover cost. So that is going to be a profit in futures. That divided by the investment that you make, it will give you the return on the future side of it. So in that particular case itself, compared to a cash market, let us say let us say the cash market gives you 10% return over 1 year. Let us say today the market is 14,500. Next year it goes to 16,000. So 1,500, approximately a 10% gain. So this is a cash market gain for you. Now in the case of a futures, assuming that you are paying something like 50 to 60 rupees premium, which is around 0.4% every month. So that comes to 4.8 or 5% annualized. Let us say in futures you pay a rollover cost which is 5% per annum. So the result that you will get is something like 5%. Right? So 5%. But 5% is on something like a 15 or 20%. So in that case you multiply this 5% into 5 because of the leverage that you have taken. So you get a 25% per annum, right? You get a 25% per annum profit. Not profit, it's a return on investment. So if you get some decent return above the rollover cost, then you tend to make definitely some money. So that will happen over a period of time, because if you see in the last 3 years, at some stages you will always have a 10% return. In 1 year, probably it could be a little bit volatile, but even in 1 year, most of the time you will get a 10% return. In a 5-year period, definitely you will get something over a period of 10%. So if you keep rolling over the futures, at some stage there, you are sure that you will get something like a 25% per annum for the investment that you have made. Probably if you add more futures on dips, then the return is going to be much higher. So this fact is very much known. But if you see, the market is returning only something like a 10% or 15% per annum. We have not seen a spectacular rally which is more than 15% per annum. So it's normally around 15% per annum is one of the best case scenarios as far as the market, as far as the broad market is concerned. So if that be the return, let us say you are paying a call option premium. What we are trying to do, we are trying to draw your attention. We are only trying to draw your attention to the advantages and disadvantages of option, and also that to use the option. I am not going to talk only about the disadvantages, but you should also know the disadvantages and you should know also the advantages. What makes what differentiates between a professional trader and a trader who enters the market new? Now, the professional trader or the institutional traders, normally they are not, they are resourceful. That is the most important thing, is they are resourceful people. Second thing is they may be more knowledgeable. They have better tools as far as the application is concerned, more information and also more resources. So based on that, their ability to win is higher. So what does a resourceful trader does? Does he buy an option? It may be for certain circumstances. That is, nothing can be said that you should only be a buyer of an option, you should be a seller of an option. There will be circumstances, there will be days when probably you need to buy an option. There will be many more days when you need to avoid the option buying in a consistent manner. Now, most of the institutional traders or professional traders, it is not that every day they would like to know, keep on buying or selling the options, right? So unless certain things happen, then in that case they shift their strikes or do some change in their portfolio. But generally speaking, let us say they take a big view that let us say the market will not go below certain levels or go above certain levels, and place their bets on those areas. And then after that, probably if it starts even going that, then there could be some shift in that particular strike or the portfolio of options. Now, the reason why generally a resourceful or a institutional trader avoids being a consistent option buyer is the premium. Now, the premium we have already highlighted before. The option premium decays. So that is the biggest disadvantage in the option. So the Decane option, so option decay, this is the biggest disadvantages, okay, and probably the volatility depending on this could be favorable or this could be negative, but this is definitely for a buyer option is always a negative thing. So this is what really kills an option trader. Okay, so mostly they say either you're long gamma or short gamma. I don't want to get into too much of technicals on that aspect, but it all depends on suppose if you are betting that there could be some big announcements which can probably move the market on either side. Okay, then in that case probably they would like to bet on the volatility and be on the long gamma, or probably go long on the option, long on the on the call or on the put, depending on what they see. Or sometimes they could be a straddle buyer where they could buy long call or and also a long put. But if the market does not move, then it could be killing. Now, last 1 month, if you have seen, if you see any particular pattern, 14,500, it goes down, comes back to 14,500, 14,600, somewhere it goes up, comes back to that. Even 14,900, 15,000, it touches 2-3 times. So that means anybody who buys around any of this particular price has to pay a price as far as the decay is concerned, because if it is to come back to that level after some days, then in that case the premium that you pay today will not be the premium after 10 days, right? Suppose let us say today you pay in option, let us say you are paying 350 rupees for 1 month. Now let us say 14,650 call you are buying, okay, or 14,700 call you are buying. Let us say you are paying 350 rupees premium, put or call, and after 15 days, let us say it did not give you much of a profit, you are waiting for some big movement to take place. So after some days, it comes back same to 14,700 after 15 days. Will it be at 350? It will not be at 350, it could be 260 or 250, right? So this is the decay. So this decay will keep on hitting you, So the option time decay is very important, that you should look towards understanding, and you should always keep thinking as an option trader, whether it is this option decay, whether it should be there in your portfolio or what you should do in order to mitigate that. Second thing that normally is that a trader normally should understand, let us say for a week, since we are talking about a week, let me not go to the month, let us say in a week. Now, if you look at it at the start of this settlement week on Thursday, assuming the rate was any rate, let us say 14,500, okay, 14,500. Generally speaking, nowadays the premium is something like 1.25%. This particular volatility which is there of IV of 20%, okay, is going at something like 1.25%. And most of the time, generally speaking, 1 week thing will be closer to 1 to 1.25%. I think getting it much below 1 for a week is unlikely. Okay, so because even doing lesser volatile period, this could be something like 1%. So 1% normally will be, mostly you will have a volatility with such that there will be, because now it looks at 1.25 means it's 190, because on 15,000 that will become something like 190 rupees or so. If it had been at 8,000 levels, this could have been something like 100 rupees or 80 rupees or so, right? So 1.25% normally, is a very probable thing that that could be there. Okay, so now let us say this 1.25% is 190 rupees. Let us say you are buying a call option. Okay, now assuming the market, normally what is the pattern of this one? So even if you are going a little bit slow, I think we will come back. We will have continuity of the discussion, because I want you to understand so that we put in various strategies. Then in that case, we also look at how that particular strategy work the next week, all those things. So kindly bear with me if you're not completing this topic today itself. Now, generally over a period of time, let us say, you're tossing a coin. If you are tossing it only 10 times, chances that you may have even 7 or even 10 heads also, possibility, right? 3 can be 3 or 0 tails possible. This is possible as far as 10 tosses are concerned. But let us say the captain does 100 times. Do you think 100 times he can give heads? It may not. It may come down to 70-30, right? Suppose he does 500. Okay, then in that case it can come to 300-200. If he does 1000, chances that it could be 550-450. So, or sometimes it could become 500-500. So as you increase the numbers, then the chances is the probability could come even. Okay, 50-50, 55-45, depending on the luck of a person or so. So what happens in the case of a upside or downside? Now, when I say upside or downside, let us say you are having a starting point. Let that starting point be the week settlement at the end of Thursday. Next Thursday, whatever the futures rate is, or whatever the spot rate is. Okay. Now, if you look at the last from 2014 till now, okay, there have been 335 weeks. Okay, let us say 335 weeks from any one particular date in November 2014 till now. Let us say 335 weeks. If from what we have seen, this has come closer to 191 weeks is on the positive side. That is, it has closed above the previous week settlement period. Let us say this week is 14,500. Above 14,500, next week closes there. Like that, it is 191 weeks. Below that 14,500, the previous settlement close has been 143. So you know this 191 out of 335. What is the ratio? 57-43. So generally speaking, the extended period of time, call and put in this, normally it goes like this, something it could be 40, 55, 45, it is never that call will come a little lower over a period of, because the market has to go up, right? So since the market has to go up, there has to be some numbers which is greater than 50. So it could be 55, 57 or so. So this is generally 55, 45, 57, 43, okay, over a bigger period of time. But let us say in last 1 year or so, market from last April, I think it has been in a steaming rally, right? What do you say? In that particular, that 55 weeks which we have observed in the last this one. So here, 34 weeks is on the positive side, above the previous Thursday close. or Friday close, whatever you want to take. 21 weeks is on the negative side, right? So this could mean a 60-40 ratio, right? So this is a 60-40 ratio. I told you a longer period of time it goes, it gets closer to the 50-50 levels. But in the case of call input, it cannot be 50-50, it could be 55-45. Now in this particular case, it's 60-40. Okay. So 60 times it's on the positive side and 40 times it is on the downward side. The reason why we are highlighting this now, let us say approximately for the time being, let us imagine that it is a 50-50 game. Let us say 50-50 game. Now you pay a premium which is 190 rupees or 1.25% of the strike price. This is the premium that you are paying in terms of absolute number or in terms of percentage point. The reason why we are highlighting about the percentages, if it had been, if you take it on some other day when probably the market was lower, then I think 190 may not be there for a week. It may be 1.25%, it could be 80 rupees or 100 rupees, right? So here we are only highlighting it as a percentage as well as number because of easy understanding now. Now, let us say the market goes up, okay. Say, let us say it goes by 14,500. Next week close is 14,880. Let us say 14,880. Then in that case, what happens? Now you take a profit, the absolute gross profit comes to be 14,500 call option you bought, because that was the weekly settlement close on Thursday. And so next week you expect it to go up, which is a 60-40 game. So you expect 60 times to be a winner. So if you are going to do it consistently, are you going to make money? That's the big question mark. Now let us say it comes to 14,500 plus 380 comes to 14,880. Now then what is the profit? 380 minus 190, because you have paid a premium of 190, right? So your profit is going to be 190, right? Your profit is going to be 190. Now let us say the remaining periods, okay, 50% now we are talking about 50% there is a chance of winning and 50% there is a chance of losing. Next 50%, let us say in the say 55 weeks, assuming now it was for 34-21, if it had been 28-27, let us say it's like that, okay, which is also possible sometimes. If that be the case, then what would have been the result? You would have got 190 rupees profit here, and in the remaining period you would have lost 190 rupees because you are paying a premium, and the price next week's settlement close is lower than the previous settlement close, which was your strike. So that means the entire premium is gone. So assuming that you had a profit of this, that there is a loss of that 190 rupees, then you will end up with break even. You will end up with break even. Even if 60-40 would have given you marginal profit if every week it had come like this. Thus every week have a price which will be at least double your option premium compared to this. This is another question mark. So what you need to do is, you need to do definitely some amount of statistical testing, which is easy. It's not that it's difficult. A little application of whatever that we have studied, mathematical concepts, will help you to understand this. So that means if you are a trader and if you are impatient, okay, now and you are not taking the profits at the right level, there is no chance that you will win in buying an option consistently. Because what is the tendency? The tendency is, if the general tendency is that if the market goes down, you always remain with the hope that it will go up. This is a very normal tendency. So you be patient, and when you are patient, then the patience, let us say, because see, one thing we have to know, that markets don't work in the timeline of our choice. That is, no, we expect that this week itself it should go up. It doesn't happen. It doesn't happen as per our choice. It happens, it has its own mind and gives a result which is a cumulative expression of interest by so many participants. So assuming that the market does not fit in our timeline because of the option premium that you have paid for that week. So because you have paid for that week, it is expiring. You will lose money if it does not go up, right? For your urgency, it will not work. For your urgency, it will not work. So what is if you look at whether the entire period, whether such a performance, that if you have just remained patient and you kept quiet, you didn't do anything, whether it has given double the profit, at least double the amount, double the gross profit, it is double the amount of option premium that you have paid, because we are talking about a near 50-50 scenario. May not be 50-50, it will be 55-45 or 60-40. But for understanding purpose, I am saying let us say 50-50. Then in that case, you need a gross profit which is double the amount of option premium that you have paid. Are you getting that? So that is what will decide. And also, even if the high or low, let us say in the case of a call, probably the high could have been something more than this. Okay. Now, let us say you are waiting for it and you are not taken profit, but on the close it can be lower. It can be lower. So let us say it only closes like this. Every time, those times when it is on the positive side, it should close like this. It should close like this. If it closes like this, then your chances of overall doing a call option will be profitable. Similarly, if you look at the put option. So if you are a buyer of a put option, okay, the same thing which we talked about applies as far as the buyer of a put option also is concerned. So the call option buyer and the put option buyer have to understand one important characteristics, that is, over an extended period of time, the option premium that you have paid, does the market go up like that? Now, when we are talking about this, let me say this. Now, in this entire period of 335 weeks, let us say at one time it was 8,900 at the start of this 335 weeks before. It was 8,900. Let us say it has come to 14,500. So what is the 5,500 to 5,600? 5,600, right? So in this entire 5,600, you let us say divided by 335. Okay. Then what is the so what is the thing? It has gone up by 17 rupees per week. Right? So 5,600 points divided by 335 weeks. Okay, it has come to 17 rupees per week. That means on an average, plus and minus put together, this is only averaging at 17 rupees per week. It is over a period of 335 weeks. I am talking about 7 years issue. What probably happened, we look at the last 1 week, last 1 year also. But last 1 year, the performance we should not take fully, because this has been an extraordinary year of up and down. Okay, the fall also was steep and the rise also was steep. So we should not use one particular extraordinary year to carry our strategic thinking. We should look at what happened over a period of time, and also during periods when if you are a call option buyer, you should always also look at what happens even in a static market. So you should always look at the negative scenario also to arrive at a proper strategic thing. That is, you should also look at the positive time. You should also look at the negative time, because the most positive thing will give you what is the best that even this could have given, even a best possible circumstances. Now this 56 weeks that happened since last year has been one of the best performing bull run. If you look at from the point of the 7,500, 8,000 it came. From there it rallied up to 14,000, which is almost like an 80% rally from the bottom. This is one of the best scenario. In that particular movement itself, how much profit that you would have made by being a consistent call buyer is what you have to decide. Now, if you are a futures buyer, probably I told you, if the return is more than the rollover cost, then there will be some return on investment that you have made. That will be this one. So a futures buyer is happy with that, because he is not paying for any as far as the decay and all is concerned. But there also he has a problem in the sense that he cannot be a seller over a period of time, because the market goes up. If he is a buyer, he pays for the rollover cost, right? So this is the dilemma which is there also. Now here, if you look at it, when you are getting only 17 rupees per unit, okay, I am talking about, let us say 190 rupees as an option premium. 190 rupees per week as an option premium. Then in that case, see, this is from 17 rupees we are talking about straight away from this 8,900 without any sinking down, then moving up. So it is there. So here it has to probably, if you buy a call option, if there is a deep fall, probably, let us say, for understanding purpose, let us say now it is 14,500. Let us say. Now, if the market sinks below 14,300, because 190 rupees premium or 200 rupees, I am approximating it here. If it is below 14,300 next week, then probably the call option that you bought is better than the futures as far as the long-term interest is concerned, because you lost only 190 rupees there, but whereas in the case of futures you are losing more, right? So in this particular case it is helpful, but when it goes up, then in that case the futures will be performing better than this. So if you look at it, we have already said that the number of times, that is the number of weeks that the futures goes up, is definitely more than the number of times the futures falls. So that means that itself shows you that, and also if the futures is only going to make 17 rupees per week, how does a consistent call option buying is going to be helpful? Unless there is a tear-away rally which is not 17 rupees. Now, the last 1 year or so, if you see, probably a call option buying would have worked, mainly because to some extent, because what happened is the last time, let us say at the period was around April period or so, also it was something like 8,500. So same thing has come to 14,500. So you have got a 600 points, more than approximately, divided by 55 weeks or so. So this would have given you a decent amount of money, right? So this is 6,000, right? So 6,000 divided by 55, this would have given you more than 100 rupees per week profit. 100 rupees per week profit, but because of the ups and downs, probably the call option buying could have just worked, okay, with some profits compared to the futures, okay. So even in the best of the bull circumstances, we are seeing that it is a very tight call. It's a very tight call. But if it is not going to be like that, if it is going to be some ups and downs, then in that case, it is not going to be a winner at all if you are a consistent call option buyer. Now, in that particular case, last 7 years, let us say, we had this 335 weeks. Now, in this entire 335 weeks, the total return which is above zero, that is positive return. In the 191 case, I told you 191 is positive, 143 is negative. Out of the 334, 143 or 144, please excuse me for that, for 334 weeks or so. This is positive to that extent and this is negative to that extent. So how much is 191? That is 191 times when the market was up compared to the previous week. What is the gross return? If you look at it, what is the gross return that we got? Is 315%. It is 315%. And this 315%, okay, now let us say you keep this for mathematical understanding, 191, you got 315% return. Let us say you paid 1.2 like this, because previously also there have been very extremely volatile time, there will be slightly less, slightly more premium. So approximately 1.25% you would have paid. I am taking 1.25%, which is the present premium that to be paid. In that case, what is the return that you have got? 315 minus 191 into 1.25, because every time in this 191 times, you would have paid 1.25% premium, right? So 1.25, 1.25, 1.25, you would have paid 191 times for the gross return that you have got. So what is the return? You would have got 191 into 1.25, 238. So this comes to 238, right? So 315 minus 238. So the profit that you have got in this 191 as far as the call option is concerned is something like 78%. 78%. Now this is 191 times, but this is 335 weeks. So remaining 143 weeks, you would have lost the entire 1.25%, because it is not at all in the positive zone. So entire 143% you would have lost. So what would have happened is 143 into 1.25%, right? So this is the loss straight away. So 143 into 1.25, is 178. So this was minus 178%. Here you got 78 in this positive week, minus 178, that means minus 100%. So that means a buyer of an option would have definitely lost. A buyer of a futures would have anyway gained, because there is always a movement which would have given him 315. I will not come to 315 is 191 times, another 143 times there has been a loss. So that minus this, still there will be some some profit during that particular period. Okay, so you'd have still got some out of that, right? So here it's a question of a complete loss for a call option buyer. So that means what does it be if you are a call option buyer? If you are lost, then in that case automatically what is the corollary? The call option seller would have made money. The call option seller would have made money. Now to the extent of 100% over a period of 335 weeks. So divided by 335 will give you the percentage that probably you would have got. So we will come to that point a little later. Now let us look at what would have happened as far as the put option is concerned. Now the put options buyer, his profit is around 249% if you had bought, and this is 143 times. This is a gross return. So what is the net return? 249 minus 143 into 1.25, right? So that comes to 143 into 1.25. This is minus 179, right? So here the profit is 70%. But remaining 191 times you will lose 1.25, because if the market is higher than that, then there will be a loss. So 191 into 1.25, loss is minus 238. So what has happened? A buyer of an op there would have lost minus 168. Minus 168. Minus 168. So a buyer of a call option would have lost minus 100%. A buyer of 100% minus 100% over a period of 335 weeks, right? Similarly, a seller of an option would have lost minus 168%. What is the futures person would have got? There was a 315. This was a positive thing. Minus 249. That is the loss, because he is a buyer. So 315 would have been his gain, gross gain. 249 would have been his loss on the downside whenever the market goes up. So you would have got some 66% or 70% over a period of 335 weeks, which is 66%. That means over a period of we are talking about 6.5, 7 years. So the return is approximately 10-11%, okay, per year. Okay, this is what the analysis is. So that means when you are getting only a return which is around 10 to 11% or 12% return over a period of time, okay, absolutely you have no chance of winning by buying a call option premium consistently. This is the underlying message you can take. So the return has to be quite substantial, but that is not going to be possible. Now what do you mean by substantial? Now let us say in the last 1 year. So that means we in this particular thing, again I am telling you, we are now only highlighting the characteristics. So we are not yet come to the strategies. We are only telling you the facts. That means if you have sold a call option and sold a put option, let us say, we will again talk about all these things later on, because I am unable to restrict myself not to talk about this because of this minus 168 minus 100. That means if you are a seller of a call option, seller of a put option, okay. Now what is the return? You would have got minus 268, which is higher than the 66%. Now let us say you have sold the put option alone. You would have got minus 168% in this particular case, which is higher than this 66% return that you have got. Even if they have sold a put option, a call option, even if you sold a call option, when the market goes up, you would have made 66% here, you would have made 100% there. That is the most, I would say, something which will be even a little baffling for you, that I am selling a call option and market goes up, but I am, how do you say that I am making money? That's the truth. That's the statistics. Because you collect a premium which is more than the advance in the rally. Now, does it happen always? over a period of time it happens, because over a period of time the market gives you only a return of 10-11% per annum. In those circumstances you will definitely win. But whereas in this particular 1 year or so, let us say this particular 1 year, okay, period, this is the last 55 weeks or so, I would say, the market has also rallied from 8,500 to 14,000, 6,000 point, probably returning something like I would say 60%, 70% return, right? Because 5,000 points is around 60%, 60, 65, 70%, whatever it is. So in that case, the positive thing is 100%. Okay, in those 55 weeks, we are 34 weeks on the positive, 21 weeks on the negative. 21 weeks on the negative, right? So 34 weeks and 21 weeks is the case. Now in those 34 weeks, what is the gain that we have made? Okay, the gross gain that we made is 100%. The gross gain made was 100%. Now 34, then in that case into 1.25%, right? So every week we are paying 1.25%. So this comes to something like 42% or so. So the net return that we would have made in this case, if you had bought only the call option, okay, if you had bought the call option, on the positive side is 58%. Now we have got to account for this 21 weeks when the market has fell, right? So there we would have laced at 1.25%, right? So this comes to 21 into 1.25. This comes to 26%. So this is 58 minus 26%. So 32% is the gain that we would have made by buying call option in the last 1 year. So it just drastically changes, right? The last 5 years, we said that by selling last 7 years, we said that selling call option consistently has given you a minus 100%. But this particular year alone, if you have sold the call option consistently every week for the last 55 weeks, you would have made a loss of 32%, because the rally has been substantial, because we are accounting for a performance of more than 60% climb the last 1 year. 8,500, 9,000 or whatever it is to 14,500, that difference comes to more than 60%. That's a phenomenal 1 year rally. Now when you're talking about those places, we are talking about a 10-12% per year, but you are talking about a 60%. So only in those type of phenomenal rally that takes place, by selling a call option, you would have lost. Now let us look at the put option side. Okay. Now in the case of a put option side, let us say 21 weeks is negative, and in those 21 weeks, the return that you have got is 40%. 40%. So 21 into 1.25 is minus 27 or so. So here you would have got 13%, right? But in 34 weeks, you would have lost 1.25%, because those are time by buying a put, you would have got 34 weeks on the wrong side. So 34 into 1.25, sorry, 34 into 1 point, that comes to 42. So the net return is, if you are buy of an option, this is a loss, this is a profit, right? So 42 minus 13, you are going to have something like a 29% loss in case if you are a buyer of a put option. Now comes the question, if you are a seller of a put option, you would have got 29% profit. Of course, in the case of futures, it rallied by 60%. So what we highlight, one common characteristic that we have got is that a seller of a put option on both sides, whether it is 7 years or it is 1 year, he has won. And in the 7 years period, he got minus 169% compared to even the futures growth, which is 66%. That means this is a big gain. And in 1 year, of course, he got some 29% by selling, whereas the futures rallied by 60%. Right? So net and net, you still look at the overall performance. Then in that case, a seller of a put option makes money. Seller of a call option, if there is a phenomenal rally, he makes a loss. But over a period of time when the return is only going to be 10, 11, 12%, he is going to make money. A seller of a call and seller of a put option put together is unlikely to lose money over a period of time. Okay. Now, in this case also, if somebody, if you had sold a call option, you would have got 32-33% knocked off. If you had sold a put option, you would have got 29%. So almost you would have been break even. By selling both sides, last 1 year you would have just, probably would have had a break even, right? You just would have had a break even, because the entire 5,000-6,000 points accounted for the 55 weeks is something like 100 points or so. Okay, so there you would have lost this one, that is in the call option, and put option seller would have made money. A seller of a call and seller of a put would not have lost here, but over a period of 7 years you would have made phenomenal money even compared to a buyer of a future. Okay, so one important point that we are getting is seller of a put option at the money makes money. We will see seller of an option slightly out of the money whether he makes money. We are also highlighting the fact that a consistent buyer of a call option over an extended period of time with a normal return of 10-12%, definitely a buyer of a call option is also going to lose money. He makes some money when there is a phenomenal rally. So if the phenomenal rally is over right now, and from now onwards it has to be because after a fall, that means what is very important, if the market falls by 15-20% from the top, then in that case you should not be a consistent seller of a call option. From there it is going to make money. But once it has rallied significantly, then in that case probably the seller of a call option also makes money. So this goes to bring us to important time frame, that is a seller of a put option makes money consistently, a seller of a call option also makes money over a period of time, but he has to be only thing vary that after a big fall he should not become a consistent seller of a this one, that is the call option. So there in that particular case, after a big fall, then in that case you can be a buyer of a futures itself if he wants the market to go up, or probably not knowing whether it's going to be a phenomenal rally or again now, he can still be a consistent put option. Return may be lower compared to a futures, but definitely is going to be a winner still over a period of time. But what prevents us from doing this of a seller of a call option, seller of a put option at the money right now is that what is good for an institutional trader, what is good for a resourceful person, it may not suit us. So that brings the personality. Now the facts and statistics say do this, but whether we can do that or not, then in that case for us to do, and what type of strategy is there for a conservative trader. Now I have told you clearly a case of an aggressive trader. Okay, I have not come about the margins of them. I am just highlighting the risk reward scenarios. Okay, we are now going to look at what are the strategies that you can put which is going to make money as far as a conservative trader is concerned. So when you are talking about a conservative trader, then in that case we are going to talk about a spread option, a butterfly option. If you do that consistently, can you still beat a futures with a lesser amount of money? Please wait and join us for this on coming Friday. Thank you very much. Questions now, please. See, maybe for those who are new to option trades, this may look to be a little advanced, but we have had basically many webinars on call option, put option. Now we are coming to a place where we are highlighting what type of characteristics of these options are, the profitability, the percentages, and so what type of strategy for an aggressive trader, what type of strategy should go for a conservative trader. And after that we are going to highlight on every week basis what strategy that you should do. Please follow that and you can see the result. Thank you very much. So thanks for your participation. Stay safe. Hope to see you on Friday. Thank you very much. Good night.